Hi, I'm Aoife Devitt. I'm sitting here in Geneva in the offices of Syz Bank and delighted to be joined by Charles-Henry Monchau, who is Chief Investment Officer of Syz Bank. Welcome, Charles-Henry, to see you here. He is a very frequent commentator on LinkedIn, and I love to follow his original takes on some of the economic vibes and other developments across markets. And it has been definitely a summer of change and some tumult, I think it's fair to say, in terms of tariff news, geopolitical events, a very literal hot summer, as well as movements on the bond front and also on the equity market front. So I'd like to kick off with our first topic, which is always around the economic vibes and inflation. And I think I'd love to take your view, not only from a global standpoint, but here we are in terms of the sitting in Switzerland and the European standpoint. Inflation clearly is not where we want it to be, a bit of a spike with the energy in terms of oil and with the geopolitical developments, but subdued enough that we seem to think we can keep rate hikes at bay. What is your take on the inflation level that we're seeing globally and particularly Switzerland, and how that's likely to feed into central bank policy?
Sure. Well, to start with in your question, you have Switzerland and globally. And actually, they are so different.
Yeah.
So let me first start with Switzerland. In Switzerland, I think we have a very unique situation in the sense that the constitution of the country, so back to 2003, it was voted by the people to cap debt. So we cannot expand debt as much as other developed countries are doing. And this is why, by the way, that if you look at our debt to GDP is 35%, we are not running budget deficits. This year is a budget surplus. And the consequence of that is an inflation rate which is quite low and a currency which is quite strong. And both obviously goes together. So this is the unique situation of Switzerland, because then compared to the rest of the world, for various reasons, would be demographics, with also all of the pension fund issues, the need to invest into energy transition, they need to invest into defense, more than ever, and not just the US, but also China and Europe, and then AI, plus all of the energy infrastructure which is needed for AI. All of these spending needs cannot be covered by rising taxes. So what they do is that they increase debt. And this debt is, which has been growing for years now, is also creating a self-fulfilling inflationary process. And I think this is what we are currently seeing, is inflation which is probably stickier than anyone would have expected a few years ago. Obviously, as you rightly mentioned, there is also now the Iran war dimension. But then there is, let's say, it looks a bit scary on the let's say, first sight. I tend to lean more on the positive side, because here what is very often underappreciated by the market is that this is leading to nominal growth, because we are not in stagflation situation. We have inflation plus real GDP growth. At the time we're speaking, the Atlanta Fed nowcast is talking about 4% real GDP growth in the US in the third quarter, plus inflation rate, which is about 3%. We are talking about more than 7% nominal growth for this quarter. And this growth is feeding into the revenue growth, the top line of companies, which is bullish for the equity markets. Yeah. So yes, there is inflation, but there is, a nominal growth cycle, which is very different than last decade. And the consequence of this is that it's rather positive for equity, real assets, and private equity, and not as much positive for bond markets. And this leads us to, let's say, kind of have an overweight structural allocation to risk assets compared to fixed income. Yeah. So that's, let's say, the negative dimension of inflation, at least for now, is kind of offset by all the positives.
The positive growth, exactly. And I think, do you think that's why because of this growth, that the market has not been as focused on these budget deficits that are in place outside Switzerland?
Yeah, so, we had 2 quarters of earnings growth in the US, which I could only, remember in the recent past, in terms of by how much they have been beating the street expectations. How can it be that with so many small people on Wall Street, they are wrong by between 20 and 25%, on EPS growth for all of these listed companies. Because probably, it's the let's say the strength of the AI super cycle is still probably underappreciated. But when you have such, let's say, a strong earnings growth season and year, obviously that's positive for the market. And I think the market has been kind of focusing on this. It doesn't mean that, coming back to your point, that at some, we could not face later on a risk that the bond vigilance are coming back, and that certainly the market start to focus on the fiscal side, which is how all of this spending is fueled at the debt at the state level.
Yeah.
And we had a few, let's say, days like this over the summer where suddenly, with yield picking up, suddenly the market start to panic, because obviously higher bond yields means that valuation on the equity side needs to come down. But we're not there yet. For the time being, the market is very much focused on the strength of the equity bull market. We are probably in an earnings bubble. We're not in a stock market bubble. We are in an earnings bubble. And most investors, they want to ride this bubble at this stage.
Yeah. I'd like to really focus, given we're situated here in Europe, on some of the vibes we hear about Europe, or some of the counter directions that we hear about Europe. Over-regulation, yet on the other hand, less growth, as you mentioned, less exposure to AI overall and tech. Obviously, smaller markets getting smaller in some cases. More exposure maybe to geopolitics and the effect of the conflict in Iran, the conflict in Russia. And equally, but then we have this AI sovereignty concern that maybe the individual European governments do not want to be wholly reliant on models and defense systems, et cetera, that come out of the US.
Yeah.
So how do you see I suppose, the economic health here in Europe, the economic prospects in Europe?
Well, first, Europe is probably doing slightly better than it was expected. And that has been one of the lessons of the summer, is that if you look at PMIs, and real GDP growth will be in continental Europe or UK, actually, it has been better than expected. That's the first point. Point number two, there is also earnings bull market in Europe. So this is driving the equity market in Europe, which is hitting new highs because earnings have been quite strong. So despite the fact that bonds in Europe has also been picking up, the earnings, let's say, strength is enough to push the market higher, because they are benefiting from global growth. European companies are very much internationally exposed. And for the time being, trade is not as bad also as many feared. Trade is okay. So when global trade is doing okay, Europe, which is very open to the rest of the world, usually benefit from it. They would probably benefit, let's say, even more if China would pick up. Maybe we can talk about that later on. But so far, let's say, so good. Now, when you talk about AI sovereignty, I think it's very important because we are sitting here in Switzerland. I'm dependent personally on so many US-made products and services. It would be my Amazon, my Google, my Microsoft clouds, my Apple, iPhone, Meta, Facebook, Instagram. Everything is US. So we are so dependent on the US, and that's a very big difference compared to the internet bubble, where the European companies were quite strong. Remember Nokia, Ericsson, Alcatel, France Telecom, Deutsche Telekom, they were very good. Now we have ASML and STM, and that's it. So we are very light, on that side. But that's let's say, the positive of the deglobalization we are seeing. Coming backwards, 10, 15 years ago with globalization, when something was going well, all of the countries were kind of cooperating and trying to find, let's say, the lowest cost provider. Now, because of all of the geopolitical risk, they all try to be champion on their side. This is what is happening between US and China. US and China are both on their sides, investing into chips, investing into AI models. And that looks maybe inefficient at first point, but the positive of that is that each on their side, they need to grow. So that's additive, at least for now. Europe might have to go through this because, again, we cannot be, and it's not just AI, by the way. It's robotics, cars. That's a big issue for Europe. The fact that German cars are being kind of, let's say, eaten by the Chinese EVs. That's a big issue for their workers as well, because they're losing jobs because of the supremacy of China EV cars. So I think Europe will have to probably invest and reinvent itself to keep up. And that could be a good thing, That could be a positive. They might have to put regulation a bit on the sides and focus more on innovation. I think at least there are talents.
Yeah.
There are talents. There are also countries. You know, you're coming from Ireland. That's a country which is very much, let's say, open and quite strong on innovation, on technology. Also, there is, let's say, a fiscal regime, which is, let's say, pushing people to take some risk and innovate and be entrepreneurs. So hopefully, you know, there will be, let's say, some positive development on that side.
It's interesting. Clearly, speed is accelerating. Even in the US, there is an arms race of sorts going on with AI, a desire not to overly regulate. We've seen valuations, growth, the new you spoke about earnings growth in public companies, but the revenue growth in private companies has been, I think, outside the norm of any, in terms of, if we look at where the Anthropic, the OpenAI, their average run rate now is kind of many multiples of where it started the year. Can Europe's always been slower in terms of its regulation, perhaps its risk appetite, its furthering entrepreneurs. Is it going to get ever further behind, or is there enough impetus here to actually give that acceleration?
I think there is a big question mark on that. I think on the technology side, they have this pool of engineers who actually could have developed similar tools than Americans, but the issue was more on the corporate side, the regulatory side, the fiscal side. They were more incentivized to move to the US and develop, let's say, their ideas over there rather than, let's say, develop in Europe. So I think this is something that the regulators, the sovereigns needs to think about. But, you know, you will see in the coming months, you will hear a lot about, for instance, data centers being built in Europe. So they are lagging, but it's coming. So that's one of the first steps, is to have data centers. That's point number one. But point number two, maybe they might have missed what we can call the pick and shovels. But where Europe could be good at is using AI to improve productivity. Because Europe has a productivity issue. Think about healthcare, for instance, biotech, medtech, where Europe and Switzerland in particular are very good. What if they, you know, really start to use AI to enhance their productivity, enhance their R&D, let's say speed, because you were talking about speed. That's very valid, for instance, when it comes to develop a new drug. I think this is already happening. If you look at the margins of healthcare companies, of financial companies, of some transport companies, I think that it cannot be that we see so much improvement in operating margins without the help of something like AI. So that might be, let's say, the stage of the AI super cycle where they might be very good at.
And it's an intriguing concept, because often V1 of anything can sometimes be amiss. We've seen that with Internet 1.0. We've seen many failures, many kind of carcasses along the way. And then the second iteration of some of these companies may have been more robust, more sustainable, having seen some of the froth and benefited from lessons learned. Similarly, in Europe, we maybe will have missed V1 in terms of much of the excitement around the models, as well as but even in some of the cases, some of the models, we've seen OpenAI's revenue growth slow. We've seen their costs expand before any IPO in their case. We've seen the open models really gain share, and a lot of the value shift into the inference layer, or even into the components layer, as you mentioned. So it could be that this race, which in a way it probably is too late to fully participate in, will have its own winners and losers, and then we will rotate into this sort of second tier.
And the first entrant is not always the winner. You know? We remember Netscape. They lost at the end. So sometimes it's good to be a fast follower.
And let's move to China, which is clearly on everyone's mind in terms of the race around models, in terms of the perceived lack of regulation, the perceived speed to construct hospitals, data centers, any form of energy to feed into this. Some numbers out this week in terms of weaker economic growth there. Very interesting movement in terms of the China's bond yield. Its 10-year bond yield has fallen to a 13-month low, just at the same time as the 30-year was at a 19-year high in the US. So clearly a bit of a divergence. And I have one chart here showing just how 10-year government bond yields have diverged in the case of China and US treasuries. What is actually going on here in China? Is this just some kind of hiccup we come across every few years in terms of Chinese growth, where there's a reset?
Yeah, so first on the AI side and robotics, I think they're extremely good, and we can see this, with numbers. They really, let's say, in terms of AI patents, they lead, and probably the US is kind of afraid of that, how good they are becoming. They have this also homegrown advantage with electricity costs and capacities. They are way ahead of the US on that. We know that their weakness is access to energy, to cheap energy. And this is maybe some of the geopolitics which are currently going on, let's say, in the Middle East or in Venezuela and other places. But then when it comes to the growth, I think that what is a bit shocking on your chart is not just the level, is the differential. Because actually, at the time where, all of the bond markets are seeing their yields picking up, they are probably the only one in a bull market, in a bond bull market, because the yields are collapsing. And the yields are collapsing because their economy has not been doing as good as it was expected. We have seen, will it be industrial output? Will it be retail sales that are all being weak, throughout the summer? Also, I think that the kind of, let's say, coming back to previous level that you mentioned, like 30 months ago, is that I think 30 months ago, the yields start to pick up because there was some expectations of a recovery in China. And then also the yields were picking up at the start of the year because investors thought that due to the Iran war, with energy prices going up, inflation will pick up in China. This is not happening because for whatever reasons, the demand for oil coming from China has collapsed. And then we can see that CPI and PPI are extremely low. So some believe that this could be the new anti-fragile assets, Chinese bonds, and kind of, let's say, the place to hide in the bond market. But I think it's more, let's say, a reflection of how weak has been the growth and inflation. We need to keep in mind that, the real estate bubble bursting has negative consequences in the economy during years, if not decades. We know the Japanese example, and I think they still struggle with this. They haven't recovered fully from the real estate bubble bursting. And they need also to change the model to one which is much more, let's say, dependent on the domestic economy, and that will take some time. They have time. They have, let's say, it's a very long roadmap, but it seems that, it's taking some more time than initially expected.
And this comes in a context when EM investing in general has actually been doing quite well this year. And that's actually been, we've had the American exceptionalism trade. We mentioned the strength of earnings, not just in the US, but globally. EM earnings have also done well. We can also see that we're seeing this lower spread with emerging market credit. There seems to be this, the investors demanding less compensation. This chart we have here, in terms of your emerging market credit risks, the differential with US credit has been coming down, which is an interesting, I suppose, statement on the perception of US credit at the moment. I'm not sure whether we can necessarily draw too many conclusions from that, but it does seem that, with the exception though of, say, India, where the tech stocks there have really been unraveling with some malaise, there has at least been a decent trade in global equity exposure.
Yeah, and I think this is investment thesis that we have been, let's say, sharing with our clients for some time, is that, okay, we still believe in the US exceptionalism. We want to have, let's say, a very large exposure to the US, but the global bull market has been broadening. So it's key to have, let's say, international exposure, and emerging market is part of it. I would say that emerging markets are on fire because they are, let's say, going up thanks to two engines. The first one is the old emerging markets, so the one which is sensitive to commodity prices. We're in a commodities bull market. And some countries and companies are benefiting from this. And then there is the new EM, which is tech and AI. And if you look at the EM ETF, so the iShares MSCI Emerging Market ETF, which is the kind of a very strong proxy for emerging markets on a broad basis, you will be surprised to see that there is more tech in these ETF than in the spiders, the S&P 500 ETF, because of Korea, because of Taiwan. And these cheap stocks, memory stocks, are doing extremely well. They are also on an earnings bubble, and they have been driving upwards the performance of emerging markets. So that's very interesting. But as you also mentioned, there are some losers. For the time being, India, which is probably still to us in a secular bull market, but for the time they have really been struggling due to the fact that IT outsourcing is taking a blow due to the fact that AI is, let's say, kind of disrupting their business model. And this is why I know there is this underperformance of India, plus the fact that they also import oil, obviously. But so emerging markets have been kind of for us a nice place to be, and as you rightly mentioned, this is also kind of is being visible on the EM bond sides, will it be corporates or EM sovereign debt.
And I think it's a particularly fascinating look at emerging markets here. You mentioned the tech exposure, they're really the old and the new, because one of the problems with really remaining invested in US equity is its concentration. And as we get more and more concentrated there will be more individual stock volatility, more headlines moving, say, an Nvidia, or when they do come to market, and Anthropic, or what's existing in the market, a SpaceX. A single day volatility in something like that could be quite significant. So if an investor wants to really diversify, then surely, even though Asian tech will also be exposed to the same phenomena, there will inevitably be a different customer base, different pace of change, different pace of sell-off. And it seems that just more diversification is a better way to insulate.
And that's a very, very, it's a very interesting question, but also really the hard part that we as investment managers are facing, because on one hand, we can see that as mentioned before, the global equity market is broadening. So we have more and more stocks participating to the upside. But there is some evidence that there is just one trade, which is AI. And that if for whatever reason, the trades start to collapse, it will not just hit, as you said, NASDAQ, it will hit Asia stock market, it hits emerging market ETF. It will probably also hit, by the way, the corporate bond market, because the corporate bond market is becoming very heavy with the hyperscalers debts, but also with EM corporate debts. And then it will probably hit also, the energy infrastructure companies, which are so important for the data centers. It might hit material stocks, uranium, which is part of the story. So it's becoming, let's say, a giant AI bet. And we have some, let's say, perception of diversification by, allocating to different countries, allocating to different sectors, but they are quite, very much, related. I think it means that maybe the best way to diversify is coming back to the roots of investment management, which are kind of bottom-up stock picking. Because here you can find, even within the same sector or the same country, companies which have, are going through this AI super cycle in a very different way. Some winners, some losers. And I think this is why we start to see the comeback of active management. This is why we start to see the comeback of long-short hedge funds. Hedge funds are certainly, seeing big inflows, very strong months of in terms of performance. So, and that's probably positive, because there's been, let's say, so much ETF-driven world that coming back to the roots of investment, which is kind of digging into the stocks and the company business model, is quite an interesting part of the job.
Interesting. And then I suppose another phenomenon this week has been the dollar weakening. Maybe it's tied to the bond yields rising. Maybe it's tied to just a natural fallback in terms of its persistent strength. But we also tied it to emerging market strength. Any thoughts on why the dollar has been weakening recently?
Well, first, there were some thoughts at some point that the new Fed chair will lean on the hawkish side, for some times. I think that's start to evaporate, a little bit. Two, I think that's, to me, the big picture on the dollar is that I always believe that the Japanese example is like a textbook for what will happen ultimately in the US. I think if you take any sovereign, if they have to choose between saving their bond market or saving the currency, they will save their bond market because the bond market is the backbone of the economy, of mortgage markets, of the corporate world. Yeah. So they need to save the bond market. This is what the Japanese have been doing. They save their bond market because they have a debt to GDP of 250%, so they cannot, let's say, avoid that. And they have been, let's say, letting the yen just going to, the abyss. And I think that the US ultimately is going this way. First, it means for, let's say, local domestic consumer loss of purchasing power. So the currency is losing purchasing power every year. And for foreigners, is if you own some dollars, dollars is depreciating. Yeah. Because they say, it's our currency is your problem. And they will probably go with it. And we had a very, recent example with Scott Bessent this week, coming with, let's say, increasing buyback of long-dated bonds because he wants to keep, let's say, the bond yields on the long-hand side, as low as possible. And we saw immediately the consequences, dollar again losing ground, because the choice is very natural and logic. Let's forget about the currency. We got to first and foremost try to save our bond market. Yeah.
That's a really interesting, and then another vote for the diversification of equity exposure, especially if you're a US-based investor, given that you will have that last upside. The last topic I'd love to just ask you about briefly is private credit, maybe as a lens through which we can look at potential credit problems. We've spoken about that hypersensitivity around, say, corporate borrowing. I've shown slides in the past around the hyperscalers and how much they now need to pay for their debt, that there's no kind of a free lunch there on the corporate credit market. Investors becoming more discerning, more discriminating. And now this private credit with non-performing loans ticking up, and even though defaults remain low, do you see any niggling problems there with companies and potential default, or do you think that we have kicked that can down the road? This economic growth we spoke about is going to just sustain.
Well, first, the stock market never lies. So when we saw some of these private, asset names starting to struggle on the stock performance side, there is obviously a fear on the market that indeed maybe private credit is seeing some cracks. Now, coming back to the idea of private credit, I think it starts with a great idea. It's companies, they need money because they are growing. They cannot just tap the bond market. They need to tap other sources of funding. And private credit is great because also there is a demand from an investor perspective to have some kind of decorated assets. The market is also looking for some yields. And private credit on that side, tick the box for many investors. So here, we are matching the demand for money and also the supply of money coming from investors. So that's a great idea. Now, we are currently, although economy is doing okay-ish, we're in a K-shaped economy where some segments are doing very well, whereas low to mid-level consumers are struggling. Any interest rate sensitive, business models are struggling as well. And, because maybe rates are higher than many of the, if you look at the 2021, 2022 vintage of private credit funds, they thought that in terms of, let's say, rolling the debts, it was going to be cheaper than it is currently today. So now that they're facing high yields, I don't think default is that high, but many are extending maturity. So depending on how you calculate, it's a default rate. If you include, let's say, extension of maturity into that, you start to see indeed some numbers picking up. So that's one part of the issue, is this K-shape and interest rate sensitive part of the economy which is struggling. There is also disruption coming from AI, which is kind of penalizing some companies as well. And then there is another issue, which is the plumbing of these private credit funds, because private credit certainly became available for, let's say, the masses. Wholesale, this is evergreen funds model, where you have the feeling that there is some liquidity here. If you want to get out, you can get your money much sooner than with a normal, let's say, private credit fund. And then most of the investors, they forgot that there is, let's say, a line telling you that there is a gate, and that if everyone wants their money back, it's not possible. And I think that this gating system, which is a bit reminiscent of what we saw during the hedge fund bubble burst, in 2008, is kind of, let's say, killing a little bit the dream of, let's say, providing private credit to the masses. And that's why also the stock of these private asset funds have been struggling. But I think it's again, it's a process. I don't see this as something as bad as the hedge funds crisis in 2008, 2009. Investors will learn the lesson. Private credit will survive and thrive.
Yeah. And I think when you mentioned plumbing, just my final point to end on, I think what is interesting is just this, I suppose, this feedback loop that we're seeing, or a loop, let's just call it a recursive loop, perhaps, in terms of the actual, maybe it's a form of vendor financing, but we've also seen in the AI segment, we've seen a lot of cross holdings. Even in the case of this week, Etched having had raising a startup, which is now its first customer. Jane Street also happens to be the provider of some of its capital. So this kind of recursive loop of financing and being a customer, I think there is definitely a high exposure and a high concentration there. And within private credit, if we were to unpack, which is quite a web of complexity in terms of these cross holdings, there could well be some exposure and some fragility there. Just having discussed earlier the anti-fragile assets. Well, thank you so much, Charles-Henry. This has been a very wide, sweeping conversation. I think we've introduced a lot of concepts that we haven't really ventilated much before, in terms of the use of Europe and how it fits, as well as this trade-off between the bond market and the currency, which is a fascinating thought experiment to work through. Thank you very much for inviting me to your office here and to being on the Markets Happy Hour podcast.
Thank you again.